Joining us now on the Fed's interest rate cut, what it means for the economy just weeks before the presidential election, and the latest economic proposals from the candidates. Former National Economic Council Director under President Trump, Gary Cohn, is here. He's now vice chairman at IBM. You ever going to get the top job? Is it you're going to be vice this entire time?
Yeah, it's a good position. It's good. Vice is good.
Right.
Vice is good.
And former SEC chairman under President Trump, Jay Clayton. He's now non-executive chairman at Apollo and a CNBC contributor. Do either one of you gentlemen agree with and understand the move yesterday, Gary?
So let me start and say yes. I think you have to understand we're in a really unique position in terms of the Fed. We have this 90-day or 3-month window where the Fed only meets once in the middle of this window. So literally August was Jackson Hole. We meet in September, and then there's no October meeting. So there's this large window where the Fed sort of had to compress their activity into one window.
Yeah, and we were talking.
Nobody's. And maybe they should have done a quarter point a month ago.
I think you can look at the Jackson Hole speech as a quarter point cut, clearly signaling that there was a new direction. So if you, in the most, I would say, benign way to look at this, look at the Jackson Hole speech as a quarter point cut. Look at yesterday as catching up. So 2 quarter point cuts going in that way. I think that's a fair way to look at what's going on, given the window that Gary mentioned.
But what Rick just mentioned, new highs in the stock market, you're not really seeing a lot of signs of non-froth. I mean, NVIDIA's come down a little bit, but I mean, what's the unemployment rate? It's like at historic lows. There are some people that think we worked really hard to get back up to having some dry powder for the next slowdown. Why blow it now when it doesn't really? Why use some of your powder now when it doesn't seem like there's any reason?
Joey, I think one thing that's going on here, well, I think there's 2 things going on. One thing is I think we have to acknowledge that we've gotten through the prior 4-year cycle. We've been sitting around talking, all of us, soft landing, hard landing, recession. I think that cycle where the Fed was raising interest rates and raised interest rates dramatically from 0 to 5.25, that cycle's over. I think yesterday signaled, or Jackson Hole actually signaled the end of that cycle. We're now into a new cycle where the Fed's now on the other side of their dual mandate. And I think we're now also in a cycle where we are renormalizing. We're going back to normal. What a normal economy, what a normal interest rate curve looks like in the United States.
Are you sure?
What a normal.
It's not normal for me. It's normal in the last 15 years.
It is normal in the last 100 years.
Yeah.
If you look at what normality looks like, what normal unemployment looks like, what a normal yield curve looks like, the zero interest rate world was the abnormal part.
We're going back there as quick as we can.
This is where I agree with Gary. We're going back to normal dynamics. But to extend the soft landing analogy, we're landing in a different airport. I mean, we are definitely landing this economy in a much different place.
I just think of what Greenspan used to always say, which is, yeah, I have 2 mandates, but basically he ignored the job market, said if I take care of the inflation, the rest of it will take care of itself. This is a different, I was watching it yesterday and thinking a lot of different things. One is this is the kinder, gentler Fed who looks at things and is going to try and make sure you don't have the downturns that maybe we would have tolerated before.
Maybe I didn't hear it right,
yeah.
But Gary and I were talking earlier. Powell did focus on the effect of migrant workers a little bit.
Yeah.
Right? Like, do they see softening in the labor market? Not at the, what I would say is the skilled labor end.
They must.
We have strikes, so labor must feel power at that end. But I think at the lower end of the labor market, there has to be some softening being seen.
But so don't believe him when he says everything's fine. They do see something beneath the surface that concerns them.
That end of the labor market concerns me. I don't know.
I think it concerned Powell. I think he actually talked about the migrant influx and what it's doing to the lower end of the labor market, and we're seeing displaced workers in the lower end of the labor market. And I think he's concerned about that part of the labor market. We all know that in the highly skilled labor market, it's still a very tight labor market.
We all lived through 2008, obviously, and if you were like a strict, I don't know, Austrian economist, and you worry about money not having a cost, and if you worry about where it's not being priced effectively, then you worry about what Rick was just talking about, zombie companies, over, people putting money where it shouldn't be going, and there's always a comeuppance. Rick mentioned the $35 trillion also. I mean, it just seems like a weird time to be opening the spigots again.
I'm going to turn this over to Gary, but look at the middle of the bond market. Would you expect in a cut for the middle of the bond market to go up?
Yeah, look, so this is my view on we're going back to normalcy. Normalcy is a positively sloped yield curve.
Okay.
So if we think the terminal rate in Fed funds is 3%, and if you look at the dot plot, we're sort of 3.25 next year. Let's just call it 3%. It's an easy number. Where should 10 years be if we're at 3%? We should at least be 100 to 150 basis points positively sloped. We're starting to price that in today. I think if you look at the steepness, what do we've added? We've added 17 basis points of steepness into the curve today. We're getting 10-year rates up to where they should be. I think if we're 3% Fed funds, we're going to be 4 to 4.5, and I think it's closer to 4.5% 10-year rates. That's normalcy, and that's normalcy based on history. Think of what the Fed needs to see. Think of what the Treasury needs to borrow today. Okay. We're paying $3 billion of interest today to finance the U.S. deficit.
And that's not stimulative.
But wait a second. You think the Fed is lowering rates because we need lower rates to service our debt?
I don't. But I'm saying there's a supply-demand function in the world. We have demand to borrow. So remember, the U.S. Treasury issues debt. They are competing for dollars. Someone has to buy the U.S. debt. Someone has to buy every company that issues their debt. To get someone to buy your debt, the attractive feature is the yield.
Well, you just said, no, you don't agree with me, and then you explained why, yes, that is.
No, I said they're not lowering it because of that reason. They're lowering the front-end yield because they're trying to manage the job market, and we think they're trying to manage the less skilled labor market. But the yield curve has to steepen. So at the end of the day, they're not lowering longer-dated interest rates. I actually think we're going to raise longer-dated interest rates.
I think that's the most important point here. Are we going to get mortgage relief out of this?
Question?
Maybe not.
Maybe not. Okay.